This is the CRE Weekly Digest by LightBox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Dianne Crocker, and I'm here with Manus Clancy. Welcome to this week's episode. Okay, Manus, let's dive in with some news developments of the week. On the market front, we had new construction spending for June, which softened slightly. We had labor report job openings cooled a little bit in June, 7.4 million versus 7.5 million in May. Of course, the big news this week will come with Friday's July employment report. So that's the one that'll actually move markets, and we'll hear that in the next day or so. So everything else on that front was a little bit like a preamble to that. On Iran, again, we're close to an agreement, but this one is governing the shipping through the Strait of Hormuz rather than a full-blown peace agreement. But the good news is, I think even a temporary shipping agreement could pull oil prices and Treasury yield lower fairly quickly, even if a lasting peace agreement remains elusive. And I think on the equities market, they liked what they heard this week. The Dow hit a new all-time high, and I think the optimism is really a bet on a de-escalation of the conflict and investors starting to price in a scenario around lower oil prices and relief in inflation pressures. Whether it's hope or reality remains to be seen, Manus, but what do you think about the headlines this week?
Well, we've had a lot of false starts in Iran over the last 6 months, so I hope that this latest variation of talks and negotiations yields something more enduring. What we've seen thus far has been ceasefires that couldn't hold, ceasefires where it didn't even seem like a ceasefire. People were shooting at each other throughout the 30-day cooling off period. It would be a wonderful thing if this were to hold this time, and we certainly hope that it does. Let's start off with the equity markets, because I think that was part of the big story this week. You mentioned the Dow. I believe it was 5 straight winning sessions. We had a day where the Dow was up 1,100 points at one point during the day. A new all-time high there. I believe the S&P hit a new all-time high yesterday. The NASDAQ has rebounded, and it feels like June all over again. In June, we saw the markets hitting all-time high after all-time high. There was incredible AI enthusiasm. We get into July, that enthusiasm wanes quite a bit as market analysts start to worry and investors start to worry about, will this AI capital spending get out of control, and will companies ever be able to get a return of sizable ROI on these data centers and the investment in the models themselves? And then this month, it was back to risk on, if you will, in the equity segment. We saw stocks take off again. People have become very, very bullish. I'm nervous about that. It seems like it's a little bit euphoric in nature. But then again, we're coming to the end of a really, really nice earnings cycle. Earnings have been up tremendously for many of these firms, and I think the jump in stock prices reflects that.
Yeah, and you're right about the comparison to June, and if things escalate again in the Middle East, we'll probably see things move in an opposite direction. So investing is not for the faint of heart. And the 10-year yields, those backed off this week too. They're down to 4.63. late yesterday compared to last week's peak, which was up over 4.7.
We did see some relief there. It was a little bit discouraging last week when we were in that 4.72, 4.73 range, and people were talking about runaway inflation again. I think that seems to have had a little bit more impact on the CRE markets recently than it did in March, April, and May. We'll talk a little bit more about that later. So I think we have two things going on right now that may continue to oscillate for the foreseeable future. I think on the AI spend side, on the AI valuations, on the stock market valuations, I do think we'll see a lot of yin and yang over the next 6 months. I think there'll be stretches where people are completely risk on, where they believe that the sky's the limit for the productivity gains, the benefits of AI. And then we'll go through periods like July where people say, wait a minute, we're going to spend another $1 trillion in 27 and 28 on data centers and models and so forth. So I think investors will have to live with that for a while, and they may have to live with Iran uncertainty for a while more. Maybe, maybe not. We don't know. I keep my fingers crossed that this is the beginning of the end of the war in Iran, and we all keep our fingers crossed, but we just don't know. And I think that those will continue to cause oscillations for the foreseeable future.
Mm-hmm. For sure. And, the other thing, of course, that everybody's chatting about is the uncertain path of interest rates. We talked in last week's podcast about the results of the July meeting, which were basically, a neutral response, but for the first time in a while, there was dissent in the Fed with 3 voting in favor of a hike. And one interesting thing I saw this week, Manus, that I wanted to get your thoughts on was Chair Warsh came in and said, I'm no longer providing the kind of forward guidance that Powell did. And so that leaves the market to speculate over a lot of things. And analysts are parsing every word in his statements for any kind of clues about rates. And one that I saw this week was that Warsh used one word 10 times. And the analysts are saying that definitely suggests that federal policy is moving toward a hike. And that word was shock. That he's repeatedly using the word shock to frame recent inflationary pressures, things like AI investment that you talked about, energy disruption, tariffs, all as kind of a series of persistent shocks. And that if that's the lens that they're using, that it tilts the odds in favor of a hike in September, even with this week's oil and shipping optimism working in the opposite direction. So right now, I looked up the odds of a September hike. They're sitting around 65%, but I think those are pretty sensitive to oil news and the 10-year Treasury. So if prices come down, if the deal materializes, if we see the 10-year come down, then I think that 65% will come down too.
It's very interesting right now. I'm not sure if you're a CNBC or a Bloomberg or a Fox business person or none of the three or all of the three.
All of the above.
All of the above. I tend to be all of the above as well. I jump from one to the other as the morning persists, depending on who has the most interesting topic at the moment. But Lisa Abramowitz, who is one of the hosts of Bloomberg in the morning, they do a great job there, covering the overnight markets and the economic data that's coming out first thing in the morning and what is forthcoming later in the day. She put out kind of a reflection piece on LinkedIn, which talked about why we were seeing that 470, 475 10-year earlier this week. And her thesis was that there was 2 camps. And one camp is really concerned about inflation, that the bond vigilantes are back, that they want higher returns because they think the next leg up in interest rates is higher, and they're starting to kind of rattle the Fed's cages right now. And another, she said, was a temper tantrum. People saying, if you're not going to give us forward visibility, we are going to show you, and we're going to drive interest rates up. Whether it was one or the other, I don't really know. I responded to that particular post, and it seemed to get some traction on LinkedIn, where I said, and you know this before because I've said this many times, a Fed hike right now would be reckless. That this economy we are seeing is not gangbusters. We're not seeing it with home builders. We're not seeing it with consumer confidence. We are not seeing it with over-the-top GDP, right? The only place we're seeing real euphoria is in the equity markets. Even in CRE, while we've been pleasantly surprised at the growth in recent months, it wasn't 2022 or 2021. This is a market that is muddling through. And a rate hike is a device. It's a device to take away the punch bowl when the U.S. market is functioning on 16 cylinders, when it's overheating, when things are getting carried away. I would argue that, A, we are not in a carried away market other than, to some extent, U.S. equities, and B, that the market has already had a slowdown factor. Higher oil prices, higher CPI is already slowing down the market. It's already doing what a Fed rate hike would do. This would be piling on at this point. And I would urge the Fed, I'm not looking for a cut by any means. I think keeping things where they are is fine. But to hike rates in the face of what has recently been $100 oil, I think is unnecessary and reckless.
I think you need to send that comment to Warsh for his response. But I agree with everything you just said. And I think what happened in early July proves that if the expectation is that there's a peace agreement, that oil prices will quickly come down. I mean, they quickly came down in the first week or two of July, and then they started spiking back up again when that peace agreement fell apart. So there's that evidence that the market is already kind of taxing itself, and that if they resolve what's happening in Iran, then the market will self-correct, and that a rate hike would be unnecessary, essentially.
Don't get me wrong. I am not a perma-dove. Sometimes people are perma-bears or perma-bulls or perma-doves or perma-hawks. If oil were to come down to $60 a barrel again and we started seeing a 4.5 GDP, and we started to see those higher inflation numbers stick and the unemployment rate fell, sure, absolutely, take the punch bowl away. But that's not the world we're living in right now, and the Fed should not be adhering to the dogma of higher rates anytime you see higher inflation. This is a different story here. This is driven by one factor, and it's oil and oil alone. And accordingly, they should adjust how they are reacting to this.
Mm-hmm. Right. And I mean, actually, the news that came out this week in terms of new construction spending is another example of the market not being, to use your adjective, not being euphoric. You know, new construction spending, yeah, it softened a little in June, but that means it was down by 0.1%. It's down 3.5% below where it was last year. So that's not a market that needs to be held in check, you know, or slowed down with a rate hike.
And the one thing we haven't really talked about, and I certainly don't want to dwell on it, I'm not a political person, and this is not a political podcast. It's about commercial real estate. But we've seen a lot of primaries over the last 2 months. We have a major election coming up in November, and that too has the potential to reframe the U.S. economy. I think if Democrats run the table and some of the Democratic socialists score upsets in November, I think we have a different set of policies coming before us, right? If we see a flipping of the Senate and the House, I think it'll be harder for the president to do some of the things that he's done in the first 2 years. If we stay where we are, which is narrow majorities in the House and Senate, it's probably stay the course. But we have a lot of moving pieces here. We've had redistricting. We've had a lot of primaries. We've seen a lot of incumbents on both sides either retire or get toppled. And this could be a very interesting November in terms of how it impacts economic policy.
Yeah, 100%. I agree with that. It'll either be a stay the course or probably a bottleneck if the results are split. So certainly a lot of pieces to watch there.
We just have to keep our finger on the pulse and see how all these moving parts impact interest rates and commercial real estate down the road. It's very hard to know right now. A lot of moving pieces. But with that, let's move on to our next segment. As we do every week, it's time for the Dianne Crocker Data Dive.
Thanks, Manus. So I have been waiting for all of the pieces to come in for our July CRE activity index. Our loyal listeners know it's a three-pronged aggregate index of CRE velocity across environmental due diligence, property listings, and lender-driven appraisals. And kudos to Nathan Dever, who delivered me the third and final piece of the index literally minutes before we went live with this recording. So, Manus, you might remember that the June index was the first time this year that the index flowed across all three of the data inputs. The three kind of played out like this. Phase 1 environmental site assessments were down 6% from June. That was their second month of modest decline. Properties coming to market were down 20% from June, and that was the third consecutive month of decline. But on the lender side, which I always view as kind of the one that's most sensitive to what's happening with rates, the lender-driven appraisals had fallen 20% in June, but those are up 14% in July. So a lot of movement in different directions, I guess kind of like the broader market too. Definitely a mixed bag. That brings the index from 122 in June down to 110, which is more along the lines of where it was in January. So still in the triple digits, maybe a sign the market's starting to tap the brakes a little bit. But I'll add before I get your thoughts, Manus, that transactions are really kind of where the rubber meets the road. And our data on the transaction side did not show any discernible pullback in transactions in June. And in fact, June was a very, very strong month. So what do you make of all of it, Manus? I have to write the commentary today, so I need your help.
Well, I think we had been predicting a slowdown for quite some time, that we thought, how could the CRE market avoid a tapping of the brakes with yields being currently about 70 basis points above where they were 6 months ago before the war started? And with supply costs, oil in particular, up considerably from earlier in the year, I think the surprising narrative was in April, May, and June when we saw the numbers really come in quite high. I think we were surprised at how easily the market was able to stiff arm what was not just negative perception. This was real, right? Interest rates were higher. Risk premiums were slightly higher. Oil prices were sharply higher, and the market soldiered on. But I think you can only do that so long. And I think that the wear and tear of all of these things being higher has started to take a toll on the markets. And I think that that's reflected in this number. Now, we always have to kind of caveat this with sometimes the numbers get a little bit bumpy during the summer, but this felt like more than just summer bumpiness. This felt like the market was finally taking a breather on the back of what has been a lot of economic headwinds over the last few months.
Very true. And you know what's interesting? As you were talking, I looked back to what it was in July. We are almost on point exactly with where the index was 1 year ago. It's like a difference of 0.1. So year on year, it's almost level. But as we said, we're still in the triple digits. So certainly it gives us a lot to watch. And universally, the three components were not all down month on month as they were in June. So lots to watch in a very, very volatile market.
It will be interesting to see if we happen to see the 10-year come down to 440, let's say, or 430. I think these numbers rebound quite nicely. I think if we keep hovering around 470, we could see a couple more months of downturn. Certainly, I was very bullish in my predictions over the last 3 months. I said war over soon, oil prices rebound, CPI prints come in cool, and risk is on CRE, and we see higher and higher numbers in the second half. That has not gone well. That has not aged well, primarily because of the war and the oil story. I'm still hopeful that we get relief on both fronts, but it's certainly taken longer than I ever expected.
Yeah, I mean, remember when we were talking about how it probably wouldn't go past mid-year, and then we were talking about, well, it has to end because the mid-year elections are coming, and now those are, coming in much closer, and we're still, in conflict in Iran. And, maybe what's going to happen instead of a peace agreement is more of like a gradual de-escalation of the attacks there. We'll see. But either way, that would be a positive for the market.
Over time, I think I do okay with my predictions, but sometimes I'm early and sometimes I'm late. My worst prediction of all time was in March of 2020 when COVID was starting. We did a podcast at my former employer, and the three of us talked about what our prediction was for when we'd be stopping talking about the pandemic and when we'd be starting to get back to normal. And I said by Mother's Day, right? I didn't think it would extend more than 2 months, largely because I thought that Americans would grow tired of it and we would move on to something else. Obviously, I was quite wrong there. My co-hosts were more in the 6-month to 1 year range, which made them much better predictors in that case than I ever was.
I still get PTSD when I think about how long I had the kids homeschooling.
I don't think I would have the patience. My kids were old enough that they were all out of high school by then, so there wasn't that watching them from home on cameras trying to learn at the same time that they're fiddling with their video game on a second computer. I was fortunate in that regard. Moving on, Dianne, part 2 of your weekly segments, the Did You Know? What do you have for us?
So here's a jolt of optimism for you, Manus. One of the metrics that I like to look at across our platforms when a quarter closes is the average number of non-disclosure agreements. These are filed by investors when they want to check out a particular listing in our LightBox broker and investor platform. And, in my mind, it's kind of a view into the volume of folks that are out there kicking the tires. So as this number changes over time, it can be an early indicator of whether they're leaning in on listings or starting to kind of pull on their horns and retreat to the sidelines. So this is the average number of non-disclosure agreements per property listing across all geographies, all asset classes. And in Q2, that average was 139 versus Q1's 133. And that, Manus, is across a total of 270,000 listings in Q2. So pretty big universe. And the last thing I'll add to that is the highest by property type, and you can probably guess, multifamily and industrial were at the top. But a bit of a surprise coming in third was office.
That is a bit of a surprise that so many people are kicking the tires. I guess the narrative right now is that, I think you used this term before, office is too cheap to ignore. And it's probably reflected in those numbers of people kicking the tires and filling out the confidentiality agreements, that there's more and more people saying we should at least look at these things. If it's really just picking up a $20 bill sitting on the sidewalk, we should at least look at these types of assets. And that's probably what's reflective of the number. I don't think that there's any shortage on the debt side or the equity side of buyers out there. There's still an awful lot of capital to deploy. People want to invest in this market. It remains pretty confident, I would say, in terms of we're seeing people fund construction loans. We're seeing people fund conversion projects like office to resi conversions, and we are seeing plenty of developers putting shovels in the ground. So I think that these numbers reflect the fact that there are a lot of people out there that are not turtling. They're out there trying to deploy capital, put money to work, and take advantage of the opportunities before them.
Right. And the overall average is going up. So I guess there's a strong sign of optimism for the market and the fact that the motivation is still there to close deals despite everything else that's going on. And anecdotally, that's what I'm hearing, even though some of the broader industry sentiment surveys can seem like they're all over the place. So it's a good place, Manus, I think, to pivot. And let's hear what you've been watching on the transaction and development front this week.
We're talking about confidentiality agreements and listings. That reminded me of something that I've been playing with at LightBox, which I think is really cool. We've been in the business of hosting listings on our systems through both the Revere and RCM platforms for a long time. There's a bunch of people at LightBox that have been coming out with new tools to really aggregate this in a way that makes it so much more interesting to see what's out there. So I was very much a tourist when looking at listings as they were coming in through Revere and RCM. I would peek at them here and there to see what was interesting, but I wasn't a big time consumer. But now this new platform that will come out in the next couple of weeks is really quite cool. You can see everything that's listed within a certain region by property type and really kind of race through these things very, very quickly. I was really impressed by what they're putting together. I think our listeners will like this quite a bit when it is formally released in the next couple of weeks.
Yeah, it's pretty impressive, Manus. I'm really excited about harnessing our data in the new platform because it really does put our listings data on steroids. And there's a lot of storytelling that you can kind of glean from that for me, for you, for any other data nerds out there. So we should have more exciting data points to share with our clients as well as on the podcast.
I find myself, a listing will come in and I will say, oh, this is interesting. This is an office in Phoenix. And I'll look, is it class A? Is it class B? How big is it? And so forth. And instantly I can go in and say, oh, let me see where phase one activity has been happening around this. Where have the appraisals been getting done? What else is sold around here? Who are the big buyers? Who are the big sellers? There's just a lot of aggregation of data that right now is in a lot of different places, and it's not available quite yet from people, but it's coming soon, and I think people are going to really be excited by this.
For sure. Definitely. All right. So let's switch gears, Manus. Talk about what headlines caught your eye this week on the development and deal making front.
So let's start with industrial. I have a couple of big ones here. We saw a couple of big portfolio sales. The first one, Blackstone's Link Logistics, selling a $1 billion industrial portfolio to Stonemont and PCCP. Reporting there comes from The Real Deal. This is 6 million square feet of industrial space that was being sold. The second big one, Harbert Management, selling $455 million worth of assets in the Sun Belt. Reporting there by the Business Journal, the Birmingham Business Journal. And, it's the rally that never ends, right? That we talk about this all the time, that industrial sales, big and small, continue to pepper our list of big name sales every single week, don't they?
They sure do. And Link Logistics, I have to make a quick mention of Neil Chandler because I know he's a loyal listener and he heads up their environmental team. So Blackstone's Link Logistics, they're having a really, really active year in terms of industrial disposition. So their latest move was to sell a portfolio with 38 buildings, a pretty impressive 95% leasing, and the assets are across major growth markets like Austin, Dallas, Phoenix, Charlotte, and Central Florida. So certainly a lot happening on the industrial side, and they had a ready buyer to take this portfolio off their hands.
Moving on to separate property type, a couple stories in the multifamily. This first one got my interest immediately. Camden Property Trust has fully exited the California apartment market. They have sold off the last of their portfolio. In this particular case, they sold 11 properties for a total of $1.6 billion. BlackRock was the buyer there. And Camden has made the strategic decision to trade out of California and focus more and more on the Sunbelt region. And that's interesting because you don't normally see somebody go as all in as Camden is, that they are completely vacating that California market. Apparently, they think it's fully valued. Why else would you be leaving? And moving into the Sun Belt, where we've seen plenty of stories of decline in values, people looking to sell, people taking losses from 2022 to 26 as values have come down, as rent growth has leveled off. And here comes Camden flowing against the tide and looking to expand in that region, I guess opportunistically, you'd say.
Yeah, I think so. I guess my first reaction when I saw that was, are they responding to California's higher operating costs, regulation, taxes, NOI pressures, and moving into lower cost markets in Texas, Arizona, Georgia, Florida. But obviously, to the point that you just mentioned, some markets there are struggling too. It's not all rosy in the Sun Belt. So certainly they'll have to be selective in terms of which assets they chase.
Yeah, certainly going against the grain there. A second multifamily story, which kind of is a little bit different than other things that we've seen here before. This doesn't really list asset by asset or market by market, but I did think it was a sign of the times that Starwood Real Estate Income Trust, SREIT, is selling a 41% stake in multifamily properties for a total of about $1 billion. And they're doing this strategically. We've all seen the headlines about private equity facing redemption demands, that people want their money back, whether it's Starwood or Blackstone or some of the other private equity firms, people asking for their money back, Blue Owl. Those redemptions have been gated. Often these firms have had requests for 20% of their assets to be returned, and they're only obligated to perhaps return 5% in a quarter or 4%. In this particular case, Starwood selling off $1 billion in assets to raise cash to permit themselves to redeem capital. So delevering here, if you will, in a different way than we've seen other firms doing. And I thought this was an interesting story, and maybe we'll see more of it. The buyer here, Apollo. Interesting that going from one private equity firm to another.
Right. And you make a good point. It's a non-traded REIT. So if they have investors who want to redeem share, they need cash, and you do that by selling assets or raising outside capital or, restricting redemptions, which they don't want to do. And they're not selling apartments because they became unattractive. I think the fact that they got $1 billion shows that the market views the assets as valuable, but they do have to be sensitive to redemption pressure. And with this, Starwood gets a little breathing room.
Well, they always say that when it comes time to liquidate things, firms under pressure to liquidate will sell the highest valued, easiest to sell, most liquid part of their portfolio. And that comes with some risk, right? You have adverse selection if you're an SREIT investor, if they're selling the good stuff and only keeping the bad stuff, right? That's that would be another reason to get out, you might say, right?
Yeah.
Maybe we'll see redemptions go up as a result of this. I don't want to editorialize on that. And in fact, I don't own this particular Starwood REIT, but I own a different one just for full disclosure's sake. And I've held it through this downturn. So just a point of disclosure there.
All right, Manus, what other sales did you see this week that caught your eye?
This one comes from The Real Deal. This is in the office segment. I'll jump around a little bit in this portion of the podcast. Because we don't get a whole lot of price indications in Texas, because it is a non-disclosure state, I thought this one was worth mentioning. In Austin, 111 Congress Street sold for $208 million to Canyon Creek. This is reporting from The Real Deal. So a big number for an office property that you don't see that kind of number every day. We've gotten used to seeing $60 million, $70 million, $80 million for office sales. Here we have a 9-digit one in Austin, Texas. It represents $413 a square foot, and the property was 84% leased. Major tenants there, law firm Hush Blackwell and Wells Fargo. So one very positive there. A second one I'll talk about in the senior housing segment. American Healthcare REIT has bought a San Jose senior living center for $103 million. This is a little bit like industrial these days. It seems like every week we're seeing another big sale in the senior housing. It's not the kind of rally like industrial that we've seen go on for 11 or 12 years now, but this is a market that is very, very on fire right now that is really, really taking off. As I noted, Irvine-based American Healthcare REIT bought the 200-unit property on Almaden Expressway. It represents about $514K per unit, reporting there from Claire Fonstein of the Silicon Valley Business Journal.
You're not wrong there, Manus, that senior housing investment has been on fire this year. I just saw a stat that raised my eyebrows a little bit, that approximately $33.3 billion in senior housing deals closed in the 12 months ending in May. That was an 83% increase from the previous period. And I want to just mention quickly, my LightBox colleague, Bob Dearborn, sent me an interesting state ranking this week that's worth mentioning here. It was a ranking of states with the fastest growing senior populations. And by the way, they define senior populations as 65 and over. So America's 65 and over population has grown by roughly a third over the past decade. By state, Alaska grew the most, but they said that was due to folks who moved during the oil boom and are, to quote them, are aging in place. But the other in the top five were Idaho, Delaware, Utah, Wyoming. Your South Carolina made 10th in the country, Manus, with a 42% surge in seniors over the past decade. And California, where this deal happened, was pretty far down the list at 30%. But I think the data is interesting because it explains why senior housing transactions are getting so much attention right now, but also that the differentiation by state points to the fact that some states are going to need to handle more demand for things like elderly care facilities and housing and medical care facilities than other states.
Well, I guess when you talk about Idaho, Wyoming, and Utah being at the top of the list, it's no real surprise in the same way that you wouldn't think South Carolina and Florida would be big surprises either. For those Western states, you have proximity to California, which is extraordinarily expensive.
Yeah.
I think people want to stay west, but they want a lower cost of living. And that is reflected by places like Wyoming and Idaho and Utah seeing these big jumps. But I do think it's both an opportunity and a risk, right? The opportunity is for senior housing developers. You certainly have an opportunity to put shovels in the ground and build new inventory and benefit from this demographic move, this migration. But on the other hand, I'm not sure that these sparsely populated states are built for this kind of influx, right? You need an infrastructure that handles the elderly. You need healthcare. You need skilled nursing. You need people. You need labor that is capable of handling this influx. And sometimes there's bumps in the road that you find these rural areas are not really equipped to handle the types of situations you have when there's a doubling or tripling of the elderly population.
Right, very true. And it points to the reality that the demographic shifts that our country goes through over time, over decades, really shapes where commercial real estate demand will be, where it won't be. But I have to say, Manus, it brings to mind something that you brought up a month or so ago on the podcast that I really liked, which is maybe today's overbuilding of student housing becomes tomorrow's retirement community.
That could be, right? See me, one day you're looking at the 18-year-old on the lazy river and next day you're looking at the 80-year-old, right? That's that would be a stark contrast, I have to say.
Yeah, but to your point, those are typically in walkable communities, which is what the elderly need.
Right, exactly. Not a lot of stairs there.
So, Manus, two headlines this week that I thought were interesting in terms of a tale of two California cities and multifamily rents. What do you have?
So the two headlines we saw, the positive one, if you are a landlord, negative if you are an apartment seeker. San Francisco rents surged to a new record as price growth outpaces even New York City. That data comes from Zumper and the reporting was from The Real Deal. Median two-bedroom monthly rent in San Francisco proper crossed the $6,000 per month threshold, and it represented a 26% year-over-year increase. Ouch. That's, I'm sure, reflective of just the AI wave that we're seeing, people being lured back to San Francisco. We hear it anecdotally from people like Strip Mall Guy that the velocity of people flocking into the city, it's a new gold rush, if you will. It's the AI technology job gold rush that's going on right now, and it's reflected in this rental growth. On the other side of the coin, Los Angeles County rents there near a 5-year low as supply increases has really pushed rents down to a much lower level than we saw 5 years ago. The median asking rent fell 3.4% year over year, reaching its lowest point since 2021, and it is really a reflection of new inventory in that area. The county at large is doing a little bit worse than downtown LA, but both segments hitting 5-year lows.
Wow, it's so interesting. These are California's two largest coastal markets, and rents are moving in opposite directions. So pity the poor graduates looking for housing after getting their first job in San Francisco. A one bedroom there, the average is $3,750, while two bedrooms are averaging about $4,444, Manus, which brings me to our slice of life this week. It got me thinking about how much my first apartment was out of college. And I don't know why this number is seared in my memory, but it is. I got a 2-bedroom row house, a very old row house in Old Town Alexandria. Our rent for the two of us total was $850. Never mind how long ago that was, but I looked it up today. It would go for 4 times that.
Well, my first apartment was on the Upper East Side of Manhattan. I think for a very, very small 1-bedroom, we paid, I'm going to say $1,300 a month, something like that, which was staggering for me, given how little money I was making right out of college. That the last couple of days of the month, I would make sure to eat at a happy hour, right, where they gave you free food, right, that you didn't have to dip into your pocket for some cash. But then it got lower from there, believe it or not. After a year, I moved in with 3 other guys in a garden apartment in Brooklyn. The garden apartments are the ones that are on the kind of like below the walkway of the brownstone. There's nothing gardeny about them at all. Talk about a euphemism. And 4 of us piled into a 2-bedroom, and we paid $400 each. So you think about that. We were paying less in a year than what some people are paying in San Francisco for a month at that time. And it just goes to show that inflation takes a bite out of everything over time.
Yeah, for sure. I can't even tell my son what my first rental payment was because he'll go off on a tirade about how the boomers ruin the economy. They're not going to have any options.
Well, this may not make the cut, and perhaps it shouldn't make the cut, but in that apartment with 4 other people where I was sharing a bedroom with another guy, I came home one night to find a critter in the bathtub, and I didn't want to deal with it. And rather than deal with it at night, because I was the last guy to come home, and I was normally the first guy up in the morning, I said, I have to figure out a way that it's not me dealing with the critter. So I snuck over to my roommate's clock, and I set it forward by an hour. So he would think he was getting up at 7 when it was really 6, and he had to deal with the critter, not me. So that was my, little Brooklyn garden apartment story for the 1980s.
Very sneaky. I love it. He probably didn't. Did you ever confess to him?
He did find out, and we got a good laugh out of it. He was a good sport.
Okay, good. All right. Well, that seems like a good place to wrap up. Thank you to our producers at Bruning Media. Be sure to join us next week as we drill down into the news headlines, deals, and developments of the week. You can listen on all of your favorite podcast platforms and send your comments or questions to podcast@lightboxre.com. As always, thank you for listening and have a great weekend.
Let's go.